I'm Daniel Gross, and this is the number. The number today is 440 million. That is the number of dollars that Knight Trading, relatively obscure Wall Street firm, racked up in losses in about 30 minutes when one of its algorithms and software pieces went rogue and bought millions of shares of stock that it didn't want. Joined today by Matthew Zeitlin, Alex Klein. We got Klein, Zeitlin, and Gross. We may start a law firm after all this. Reporters for the Newsweek Daily Beast who have been looking into this issue. So, what is Knight Securities and why do we care about them?
Okay, so they're actually one of the largest and most reputable trading firms in Wall Street. They're actually based just right across the river in Jersey City, right out there. And they trade on their own account. And they also route trades for a lot of online brokers, like TD Ameritrade is one of their biggest customers. And so what happened last Wednesday was at 9:30, right when the New York Stock Exchange opened, they started buying around 150 shares in around 150 companies, and just it wouldn't stop. So some companies that are very thinly traded, like China Cord Blood is the best example, their share price went up more than 100%.
And they were doing all the buying because they were testing or putting in some new software.
It was new software for that day.
And then just triggered this huge flow of buying and selling orders. And no one turned it off for 30 minutes, which 30 minutes in the stock market is an eternity.
Yeah, so I think it took about 45 minutes for it to finally be turned off. And that's what's so scary is because traders, including traders in Knight Capital and other people working in the New York Stock Exchange, noticed within a few minutes that something was wrong, and yet there's no real off switch for this software.
Now, Alex, this is not the first time we have seen software sort of go a little nuts and wreak havoc in the market.
Far from it, yeah.
We had the flash crash.
Of course, yeah. Well, we're really in this sort of Skynet scenario in our capital markets these days because 60 to 70% of all equity trades are conducted by these high-frequency electronic trading machines. And 2 years ago, as you mentioned, the flash crash took the Dow for one of its most exciting rides ever when basically legions of high-frequency traders started passing back and forth these futures contracts at kind of breakneck speeds, inflating volumes and drying up liquidity.
The important thing to understand here, we had this image of the floor of the stock exchange used to be these guys matching orders.
Oh yeah.
They're gone, and we now know it's supposed to be investors meeting up online. Sort of like Craigslist. But the reality is that many of there are these investing companies out there that are basically turning over the trading to companies who are trying to get little microscopic gains, and to do so they execute hundreds of thousands of trades a day. And that is basically what the market is today.
I mean, thousands of trades even in a blink of an eye. I mean, the high bound for speed for some of these high-frequency traders is like 40,000 in a blink of an eye. If your local supermarket could do that many transactions in that amount of time, your family could fulfill its groceries for a lifetime.
So it'll be like, I just bought 1 million shares of IBM, sold it 30 times over.
And then by the end of the day, these high-frequency trading firms completely liquidate their positions.
Now, one of the other sort of software screw-ups was one of these firms kind of destroyed its own IPO. This is Bats Trading.
Right, yeah.
I actually visited them a couple years ago. This is a startup exchange. They were based in a strip mall in Kansas City.
Really chipper.
And ended up controlling about 10% of trading.
Yeah.
So what happened when they tried to do their IPO?
Well, Bats had high hopes for their IPO. They set the buy price at about $16, and as soon as they started putting their shares on their own exchange, actually, the price in a blink of an eye dropped to 4 cents.
That's not what they like to see.
No, and
at least 6 cents, 8 cents. You go for that.
There's this added irony here because they are an electronic exchange, and as soon as they started offering their own shares, the software freaked out. It started messing up bids on pretty much all shares listed on the NASDAQ between A and B. Apple took a hit as well, and Bats, of course, got blown out of the water.
We also saw, of course, Facebook. There were some software problems, and some investors got hurt. One of the ironies here, or maybe it's not ironic, is that individual investors were not really harmed here, but Knight was. They ended up with all these stocks. Goldman said, hey, we'll take those off your hands.
At a discount, yes.
And Knight was able, people thought they weren't going to exist. They seem to have managed to survive. How so?
So in kind of a flashback to 2008, 2009, they had one of these weekends where they had to figure out a rescue package before markets opened on Monday. And so Sunday night and Monday morning, they're all to announce a plan where a investment bank, a private equity firm, and actually one of their customers, TD Ameritrade, along with some other investors, put something like $400 million into the company, but they're going to control about 70% of it. So the real losers for Knight are not their customers, it's their shareholders.
Right, so this was a stock that was trading at about $10 a share a week ago. The software goes nuts for about a half an hour. These guys were allowed to buy in at about $1.50
Yep.
a share. Just goes to show you the machines, as much as they may help us, are the problem. I'm Daniel Gross.